Right now, the bank where you keep your money has about 3 days of cash on hand. Not 3 months, not 3 weeks, 3 days. And if you think that sounds insane, wait until you hear what happens on day 4. Let's start with something you probably believed until about 10 seconds ago, that when you deposit money into a bank, it just sits there, your money, in your account, waiting for you. It doesn't. The moment your paycheck hits your account, the bank takes that money and does something with it. They lend it out. They buy bonds. They invest it in treasury securities. They use it to make more money, because that's the entire business model. You get paid maybe 1% interest on your savings, if you're lucky. They make 3, 4, 5% or more on the other side. This isn't a secret. This isn't a scam. This is just how banks work. But here's the thing nobody mentions in the fine print. They don't keep most of your money accessible. They keep just enough cash in the vault and in reserve accounts to handle the normal day-to-day withdrawals, groceries, rent, ATM runs, the predictable stuff. And just enough is a smaller number than you think. This is where the system quietly breaks. In the United States, banks are required to hold a fraction of their deposits as reserves. For most of the last decade, that fraction was around 10%. Then in 2020, the Federal Reserve dropped it to 0% reserve requirement. Let that sit for a second. Technically, a bank can hold no reserves at all and still be following the rules. In practice, most banks do keep some cash on hand because, obviously, people need to withdraw money. But the amount they keep is based on models, on averages, on what they think will happen under normal conditions. And those models assume that you're not all going to show up at the same time. This assumption has never been tested at social media speed. So what does 3 days of cash actually mean? It means that if you walk into your bank right now and ask to withdraw $500, no problem. If 1,000 people do that today, still fine. If 10,000 people do it tomorrow, the bank starts making phone calls. Because banks don't operate like a vault in a Western movie, with stacks of bills sitting in the back room. Most of their money is tied up in loans that won't be repaid for years, or in bonds that take time to sell, or in investments that aren't liquid. Liquid just means you can turn it into cash quickly without losing value. And when your money isn't liquid, it doesn't matter how much you technically have. If everyone wants their cash on the same day, the math stops working. This is called a bank run. And once it starts, it's almost impossible to stop. Here's how it plays out. Day 1, rumors start. Maybe it's a news report. Maybe it's social media. Maybe it's just your neighbor saying they heard something. People start to worry. A few dozen customers show up to withdraw their money, just in case. Day 2, the worry spreads. Now, it's not just a few people. It's hundreds. The bank starts pulling cash from other branches. They liquidate some assets. They call their lines of credit. They smile and say everything is fine. Day 3, it's not fine. The line is out the door. ATMs are empty. The bank's app is crashing because everyone's trying to transfer money out electronically. The bank burns through the last of its accessible reserves. Day 4, the bank doesn't open. Now, you might be thinking, okay, but doesn't the government step in? Isn't there insurance for this? Yes, there is. It's called the FDIC, the Federal Deposit Insurance Corporation, and it insures deposits up to $250,000 per account, which sounds great until you realize the FDIC has about $120 billion in its fund, and American banks hold more than $18 trillion in deposits. Do the math. That's like insuring a city with a fire department that has water for one street. If even a fraction of banks failed at the same time, the FDIC couldn't cover it, not even close. They'd have to go to the Treasury and ask for more money, which means Congress, which means printing money or raising debt, which means a whole different kind of crisis. The FDIC works because bank failures are rare and isolated. One bank goes down, the FDIC steps in, pays out the insured deposits, and life goes on. But if trust in the system collapses, if people start pulling money out of multiple banks at once, not because those banks did anything wrong, but just because they're scared, the insurance doesn't matter anymore. Because the real insurance isn't the FDIC fund. It's confidence. And confidence is a very fragile thing. Let's talk about March 2023. Silicon Valley Bank was the 16th largest bank in the United States. It held over $200 billion in assets. It was a cornerstone of the tech startup ecosystem, and it collapsed in 48 hours. Here's what happened. Silicon Valley Bank had invested heavily in long-term government bonds. Safe, boring, reliable bonds. But when the Federal Reserve started raising interest rates aggressively, the value of those bonds dropped. The bank was still solvent on paper, but it had an unrealized loss. meaning if they sold those bonds right now, they'd lose money. Normally, that's not a problem. You just wait, bonds mature, you get your money back, but then someone noticed a loss. A venture capital firm sent out a note telling its portfolio companies to pull their money out, just as a precaution, and the precaution became a stampede. Within 2 days, customers tried to withdraw $42 billion. The bank didn't have it. They couldn't sell the bonds fast enough without taking massive losses. The stock price collapsed. Regulators stepped in and shut it down. Then another bank failed, Signature Bank. Then the First Republic started to wobble. The government intervened. The FDIC and the Federal Reserve announced they would backstop all deposits, even above the $250,000 limit, to stop the contagion. It worked. The panic stopped. But here's the uncomfortable part. The only reason it worked is because the government said, we'll cover it. Not because the banks had the money. Not because the system was fine. Because someone with the ability to print money said, trust us. Now zoom out. This isn't just about one bank in California. This is about the entire structure of modern banking. Every bank in the world operates on the same basic premise. They borrow short and lend long. They take your deposit, which you could ask for back at any moment, and they lock it up in loans and investments that won't pay out for years. This is called maturity transformation, and it's the engine of economic growth. It's how businesses get funded. It's how people buy houses. It's how the economy expands. But it only works if most people don't ask for their money back at the same time. And that assumption, that stability, depends entirely on trust. Trust that the bank is managed well. Trust that the regulators are watching. Trust that the government will step in if things go bad. But what happens when that trust cracks? Here's what keeps economists up at night. If just 5% of Americans move their money tomorrow, the entire system would seize. We build a financial system that's more interconnected than ever before. Banks lend to each other. Investment funds hold bank stocks. Pension funds invest in bank bonds. If one major institution fails, it doesn't just hurt that bank's customers. It sends shockwaves through the entire system. And in a world where information moves at the speed of social media, a bank run doesn't take weeks anymore. It takes hours. You can pull out your phone right now and transfer your entire savings to another bank in under a minute. Multiply that by a few million people, and you've got a crisis before regulators even finish their morning coffee. The system was designed for a slower world. A world where you had to physically go to the bank, stand in line, fill out a withdrawal slip. That friction gave banks time to respond. Time to call the Federal Reserve. Time to arrange emergency funding. Now, there's no friction. Just panic and a Wi-Fi connection. If Bank of America froze withdrawals for 24 hours, what would happen to Chase? To Wells Fargo? To every regional bank that suddenly looks less safe by comparison? Nobody knows, because it's never happened at this scale, at this speed, and the system was never designed to survive uncertainty. So why don't banks just keep more cash on hand? Because it's expensive. Cash sitting in a vault earns nothing. Every dollar a bank holds in reserve is a dollar they're not lending out, not investing, not making money on. And banks are businesses. They're trying to maximize profit. Holding extra cash hurts the bottom line, so they optimize. They run models. They calculate the minimum amount of liquidity they need to handle normal operations. And they hold exactly that much. Maybe a little more if they're conservative. But a little more still isn't enough if everyone panics. And here's the darker irony. The safer a bank looks, the less cash it needs to keep on hand, because people trust it. But if that trust ever breaks, the lack of cash becomes the very thing that kills it. The strength of the system is also its greatest vulnerability. Now, let's talk about what happens when the government steps in. Because the government did step in during the Silicon Valley Bank crisis, and during the 2008 financial crisis, and during the savings and loan crisis in the 80s. Every time the banking system wobbles, the government props it up, which raises a question. If the government is always going to bail out the banks, what's stopping banks from taking bigger risks? This is called a moral hazard. Privatized profits, socialized losses. Banks have gotten larger, more complex, more interconnected. The term too big to fail exists for a reason. It means some institutions are so critical to the financial system that the government can't let them collapse, even if they made terrible decisions. So the banks take the profits when things go well, and taxpayers take the losses when things go bad. And every time the government steps in to prevent a collapse, it reinforces the idea that they'll do it again next time, which makes the next crisis more likely. Here's where it gets weird. Despite all of this, the despite the fragility, despite the 3 days of cash and the moral hazard and the multi-trillion-dollar gap between deposits and insurance, the system mostly works. Most of the time, you can walk into your bank and get your money. Most of the time, banks don't fail. Most of the time, people trust the system enough not to panic. And that most of the time is what holds everything together. Because banking isn't really about math. It's about belief. You believe your money is safe, so you leave it in the bank. Everyone else believes the same thing, so they leave their money in too. The bank takes all that belief, all that trust, and turns it into loans and investments and economic activity. But belief is not a stable foundation. It's a collective hallucination that only works as long as nobody questions it too hard. And the moment someone does, the moment doubt creeps in, the whole thing can unravel faster than anyone can stop it. So what's the solution? Some people say banks should be forced to hold more reserves. Make them keep 20%, 30%, half of all deposits in cash. Make the system genuinely safe. But that would make banking far less profitable. It would mean fewer loans, less investment, slower economic growth. Maybe that's a trade-off worth making. Maybe it's not. Others say we should break up the big banks. Make them smaller, simpler, less interconnected, so that if one fails, it doesn't take down the whole system. But smaller banks have failed too. And breaking up banks doesn't eliminate the fundamental problem, which is that all banks rely on the same assumption, that you won't ask for your money back all at once. So for now, we're stuck with what we have. A system that works beautifully 99% of the time and fails catastrophically the other 1%. Here's the part that should bother you. Every few years, we have another crisis, another bank run, another panic, another moment where the whole system teeters on the edge and the government has to step in with billions or trillions of dollars to keep it from collapsing. And every time we say, never again, we pass new regulations. We create new agencies. We promise more oversight, more transparency, more stability. And then a few years later, it happens again. Because the system isn't designed to be stable. It's designed to be efficient, to squeeze every last bit of profit out of every dollar, to operate as close to the edge as possible without falling off. And most of the time, that works. Until it doesn't. So the next time you check your bank balance and you see that number on the screen, remember something. That number isn't cash. It's a promise. A promise that when you need your money, it'll be there. And that promise is backed by a system that keeps 3 days of cash on hand and a government that may or may not step in to save you if things go wrong. The system works because we all agree to believe in it. But day 4 doesn't start with panic. It starts with everyone believing they'll be the last one to need their money. And 3 days isn't very long.